Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, Washington, D.C. Metro, to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate Radio is designed to build the Washington, D.C. Metro's market by giving you good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is their off-air number. It's 877-245-2030. That's 877-245-2030. or on the web at realestateradio.dcmetro.com. So before we went back to break, we were starting to discuss interest rates and whether, refinancing is the right decision for you. We want to go ahead and jump into, what happened last week that led to these low interest rates and jump in from there on the tips to see if you're a good candidate for refinancing. This week's Word on Wealth was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to HomeGain.com today to see what I'm talking about. All you have to do is type in your home address, and you will get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free, so check it out today at HomeGain.com. So last Monday, obviously, the market was absolutely crushed after the S&P downgrade of the U.S. debt. So the Dow was down, I believe it was something like 634 points. And, we still have a lot of lingering issues with Europe, I believe. Louis, is it this week that Germany and somebody's meeting?
I'm not sure, but I know that they agreed to purchase and have started to do so. The debt of the Eurozone has agreed to purchase the debt of Spain and Italy.
Yes. Yep. So we have a lot of, lingering issues with what's going to actually go down over there. On Tuesday, the volatility was the word of the day again. The market was up 200 points, then down 200 points, then finishing up right before close at 400 points. I mean, it was just a crazy day all over the place. Wednesday, the market was getting crushed again. The best adjectives to describe what was going on in the market last week: uncertainty, volatility, broken trust. I mean, it really was a wild ride up and down, and very tumultuous for people that are looking to, to basically solidify a home loan or to lock in an interest rate.
But you know what it does, Ryan? It actually encouraged these low interest rates, encourage people to do two things: to throw money at the stock market because they can't save it, and there's no point in saving it because you don't get any interest,
right,
or to go out and get a loan and buy a home.
Yes.
That's the main idea behind what the Fed is doing. And that's really the only reason the stock market went up in 2009 and 2010 is when they had the two QEs, and they're still trying to push that concept. And if they can get away with it by borrowing more money, they'll keep interest rates low, and presumably people will put that money either in homes or the stock market. And when people make money in the stock market, the theory goes that they'll then feel rich, and maybe they'll go out and buy a home.
Right. So basically,
it's not totally misguided what they're doing, although it's destined to fail. But it makes some logic.
It's creating another bubble down the road.
Correct.
Correct.
The bubble now is in the Treasury bonds and the dollar, not in the housing market, which they're trying to reinflate, or the stock market, which they're trying to reinflate. They can reinflate those slightly, but at a tremendous cost to the dollar and the creditworthiness of the United States.
Yeah, and I was reading something this week where Donald Trump had said that he was jumping into the stock market, buying some stocks. He said this was the first time he's done it, but I heard from somebody else it was actually the second time he's done it. But he buying stocks at what he feels is cheap when the market had tanked. Ultimately, he probably will benefit from that, down the road. He made an interesting comment, Louis, was that he's obviously the big real estate investor, but he hasn't been able to find good enough real estate deals lately, which is interesting to me.
Yeah.
You know what I mean? And I don't.
You know how to find them in any market.
Right. Yeah, and I would think there's so much distressed stuff out there that he could find a great deal.
Well, maybe he can find a great deal, but maybe the market for filling them up with tenants isn't there.
That's probably correct. There's an interesting article in CNN Money where it showed that homeownership has hit its lowest level since 1965. It was showing that the Census Bureau reported that the percentage of people who owned a home had dropped to 65.9% during the second quarter, which was its lowest level since the first quarter of 1998 and a far cry from the high of 69.2% reached in late 2004. But they said that this actual statistic was a little misguided because they don't really take into consideration the delinquent mortgage borrowers who
make it lower.
Yeah, exactly. And so they had it more accurately calculated at somewhere around 59.2%.
And what you're seeing now is just the excess of the speculative part of the market taking itself down, and home ownership won't get to normal levels until home ownership is a sensible investment rather than a speculative investment.
Yep.
It'll take a while. That'll happen because it does make sense to buy a home in some circumstances. Most of the people that are losing their homes now bought them as speculative investments. And now you're getting the speculative excess winding out of the market through foreclosures and people just selling the house and getting out. But you'll get a new breed of buyers eventually who will come in where it makes sense to buy.
Yeah, and a lot of that speculative buying that took place back then too was through the means of creative financing.
Mm-hmm.
And that is no longer available. So it's kind of interesting because, the Fed and the government, they're not coming out and trying to say, everybody must own a home. Now it's kind of opposite. Now they're trying to create ideas for what they can do with these foreclosures. Maybe, like Fannie Mae and Freddie Mac, the government can turn around and be landlords and rent them out.
Another mistake. If they do that, that'll be horrific for home prices and rental prices because they'll rent those things out as government housing lower than the market rate.
Yep.
That'll also depress home values because, they'll have these government homes next to private homes. And then, of course, if you were thinking of holding on your home and renting it, you're now in competition with the government. So it's basically an ill-fated idea based on an ill-conceived concept in the first place, which was to have the government get into the housing market.
Yeah, that's the last thing we want.
They already were.
Yeah.
By creating these loans and encouraging people to buy houses that they couldn't afford. Now they're stuck with the problem, and their problem is instead of letting the private market sector take over, now they want to go in and become landlords.
Yeah.
So if they weren't good at selling homes, they're not going to be good at renting them.
Not at all. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, the general manager of HomeGain. Interesting to note, did you catch last week, I believe it was, that Bank of America had actually sold back a bad portfolio of loans to Fannie Mae? $500 billion.
I didn't see that.
Yeah. That's very disturbing to me because if you remember, the Fed was the one that pushed that deal for them to buy Merrill Lynch and Countrywide, which was a substantial pool of bad loans, especially from Countrywide. And this seems like another, a backside deal that's going on where Fannie Mae turned around and took a portfolio of $500 billion and bought that from Bank of America. I mean, the story is just never ending.
Well, it's just like everyone's buying garbage from each other.
Yeah, and it's just kicking the can down the road as we've said.
And that road, as I've said, is a dead end.
Yep. And ultimately, it's going to lead to more money creation or the printing of more money because that's the only way that we can actually pay the piper here.
Well, a lot of it comes from the whole Keynesian economic theory. Did you see Paul Krugman the other day, spouting the same old nonsense that World War II got us out of the Depression and that type of activity is good for the economy?
Yeah, I did see that.
It's just like we might as well go ahead and level a few cities and then build them up again because it creates jobs.
Yeah.
They're basically saying that the government has a solution to whatever market you're in, and if they have to destroy something to create something, they know best.
Yeah, well,
it's fascinating to see that mentality still exists, that somehow you could put more government stimulus money into the economy and somehow that's going to work.
Well, it's interesting because, a great way to create jobs, everybody knows that, a sustained real estate housing recovery would create jobs.
Absolutely.
It would, and if they really wanted to focus on real estate and not just the stock market or whatever, I think that we could really turn this job market around. But it's just the ideas that are on the table are atrocious.
Well, what you have to be willing to do is let the housing market make its final collapse.
Correct.
And then it will attract investment because the prices will be low. Even if interest rates are slightly higher, you'll get proper investment in the housing market.
So yeah, the problem is that since the government owns so many of these bad loans, that they really don't want it to collapse to the point that it would have to. I mean.
So they're in a catch-22, and also you have to have the political will to go through a period of economic, maybe depression, And as you say, when you kick the can down the road, you do avoid it, but all you're doing is setting yourself up for a much bigger depression later on.
Yeah, and you know, it's kind of interesting with all this going on, all the talk about what's going on over in Europe and, you know, what's taking place here. It seems like every day I'm listening to one of these bigger banks is selling, like, what was it? I think it's Capital One bought HSBC's U.S. card unit for $33 billion.
I did see that, yes.
Bank of America just came out and said they're getting rid of their international credit card division. They don't want to touch that anymore. So there's I think a lot of stuff that this has really not made it to the, you know, the front of the newspapers yet about what's really going on in these banks. You know, obviously we've seen Bank of America's stock price slip drastically, and I really do think that there's more to it than what we're seeing, especially with them, you know, selling such or getting rid of such a big loan portfolio. I'm curious to see what Fannie Mae actually bought that for.
Well, if you look and you try to figure out the true health of a bank, it's very hard to tell, and you can blame S&P and Moody's, but they had good ratings on Lehman's before they collapsed and so on. I think it's so opaque, their financial statements, it's hard to tell. But one can only suspect that their financials are not as good a shape as they let on to be.
Yeah, well, I believe S&P is the same one that had all the subprime bonds rated as AAA.
Well, that's probably because there was some collusion, but not understanding what the bank's actual financial position, it's quite difficult.
Yeah, I mean, it would be very difficult for anybody to really look at, you know, something just black and white and be able to really tell what's going on. I mean, the way that the banks can manipulate their books and everything else, you know, with what they actually have labeled certain assets and what the value of those assets are, they always inflate those.
Oh, sure. Like, what about all the homes that they have that aren't in foreclosure but are clearly in pre-foreclosure? How are they putting those on their books?
Right. You know, the big takeaway for me, Lewis, though, is, you know, like a lot of people thought with this downgrade in the U.S. debt that basically mortgage rates were going to shoot through the roof. And that's actually not what's going on at all. And I'm happy that it's not, because it's allowing a lot of people that want to get in to still get in and get in at record lows. I mean, as I said earlier, we were talking about, you know, a 30-year fixed rate mortgage close down to 4% right now.
Mm-hmm.
15-year mortgage at 3.5%. Now, remember, guys, this is based upon your credit qualifications, loan to value. You can't just assume that if you have a 550 score, you're going to get the best rate possible. So remember, you got to, when you're searching for a home loan and you're shopping, pay attention to APR, which is your annual percentage rate, to make sure that you're getting a good deal. Make sure that you do reach out to a professional, if not me, somebody else that will look care of your best interests. And I highly advise you guys reach out just to know what your options are right now, just because it's a very tumultuous, volatile market, and interest rates are super low. I know myself, if I had the ability to buy 20 houses right now and I could get that creative financing, I would be doing so. 877-245-2030. That's 877-245-2030. When we come back, we will jump into things to consider when renting your home.